What if I told you there are 5 smart ways to invest in your kids' future that could turn $520 a year into $300,000 by their retirement? Stick around because I'm about to break it down for you, all right? So hey, Mini Money Mentors, how you doing? My name is Camille Bank, and today we're diving into a kid-friendly investing topic, okay? Whether your child is 3 or 16, these strategies can set them up for life. But remember, just like on a plane, put on your own financial oxygen masks first. Get your finances in order before starting to save for your kids. Okay, and with that being said, let's dive in. I'm going to go over 5 points that I want to make, how you can invest in your child's future. Point number 1. This is called the 529 plans, okay? Imagine your kid confidently walking into college, knowing tuition is covered thanks to your foresight. How does it work? A 529 plan is a tax-advantaged savings account for education expenses. Money grows tax-free and withdrawals for qualified expenses are tax-free as well. Now, the pros on this one is that it's, like I said, it's tax-free growth for education. It can be used for K through 12 college and some apprenticeships as well. And it's easy to change beneficiaries. On the cons side here, we have penalties if it's used for something that's non-educational, and it may impact financial aid eligibility. Picture your teenager opening their college acceptance letter. Instead of panicking about costs, you feel calm knowing that the 520 plan you've been feeding into is ready to cover a big chunk of that tuition bill. Whether or not you need college in the future is a point that I made in another video a couple days ago. You can check that out on my channel. Now, let's get on to point number 2, which is UGMA/UTMA accounts, okay? Want flexibility beyond just educational savings? The UGMA/UTMA accounts might be your answer here. How does it work? These are custodial accounts that you open in your child's name. You can invest in various assets and the child gains control at 18 or 21. What's good about it? It can be used for anything, not just education. It's a flexible investment option. On the negative here is that the child gains full control at adulthood. And it can reduce financial aid eligibility by 20% of its asset value. So it really depends on how well you prepared your child to take on that responsibility. But imagine this, your 18-year-old is weighing options between college, starting a business, or maybe traveling, okay? Thanks to the UGMA account you've been growing, they have the financial flexibility to pursue their dreams, okay? So that's not too bad either. Let's move on to point number 3, which is the Roth IRA, and I'm sure you heard about that. Did you know that your teenager's summer job could fund their millionaire retirement in the future? A Roth IRA is a retirement account where money grows tax-free. Withdrawals in retirement are also tax-free. Now, the pros here is that it's tax-free growth, as with some of the other options, and withdrawals are also tax-free in retirement. This is great for long-term growth. The cons here is that the child must have earned income to contribute, and there are certain annual contribution limits. There's a wider topic on backdoor IRAs and how you can contribute way more if you are a high earner. And on top of that, there are certain type of ways of a self-directed IRA where you can very actively invest into even your own company through your Roth IRA. So that's a topic on its own, and I'll make a video about this in the future. But picture this while we're on the IRAs. Your 14-year-old comes home from mowing lawns, excited about their first paycheck that they've gotten maybe after a month's or week's worth. Okay, let's say they invest those $520 that they have in a Roth IRA until they're 18. They'll do that every year from, let's say, 10 to 18, and you can help them. Every week, that breaks down to $10 a week. That's really manageable. Then from 18 until their retirement at 65, this this initial investment could grow to about $300,000 depending on how the market performs, but that's historical data. Their eyes widen as they realize their summer job just became their first step to financial freedom. You got to sell it to them, okay? Now let's move on to point number 4, brokerage accounts. Want to teach your kids about the stock market while potentially growing their wealth? This is how it works. These are basically flexible accounts that allow investments in stocks, bonds, mutual funds, and ETFs. The pros here is that it's very flexible investment options, and it's great as a learning tool for kids, especially if you're investing in stocks as well. You can kind of go along together and maybe even analyze some companies together. On the negative side here is that it is subject to capital gains tax, and there are no specific tax advantages under this plan. But if you think about it, your teenager being excited about checking their brokerage app, this can lead to some stress as well, so don't let them get too excited. But what if they use this opportunity to learn about market trends and making informed investment decisions? I think if you do it on a long-term horizon, you really don't have to get this day trader mindset. And this is when you realize this account is teaching them more than just investing. It's sparking their interest in business and economics. So there's a lot to be gained from this. And then my final point is the traditional savings accounts. Sometimes the simplest solution is a great starting point. It's a basic account where money earns interest over time. Now, the good thing here is that it's safe and easy to understand. There are certain rates that you get for it, although they are very small. It's FDIC insured up to a certain amount, and currently the interest rates that are offered are a little bit higher than before. On the negative side, it's historically it doesn't keep up even with inflation, especially in the high inflation environment that we're in right now. And then we got lower returns compared to other investments that we mentioned in this video before. Your child excitedly checks their savings accounts balance, amazed at the interest they've earned, as small as it is. It's a simple yet effective way to introduce the concept of saving and watching your money grow. And that's pretty much it. 5 smart ways to invest in your child's future. So the biggest point here to remember is that the key to start is early and stay consistent. But don't forget to sort out your own finances first. If this video got you excited about teaching your kids how to become financial money bosses and little mini moguls, then stay around. I'm going to post more videos on this topic as I'm a father of 2 as well. And I would love to know your questions in the comments below. I'll see you in the next one. Bye.